Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at the mid-year review, which came and went with relatively little fanfare, something that we are unaccustomed to over the past couple iterations. However, it has gotten investors talking about some fairly recurrent themes, and today we're going to focus a bit on what some investors' concerns are or continue to be, and what investors might expect in the periods coming ahead. So let's take a look at some of those major investor concerns right now. And foreign currency access continues to be one of those major concerns, as well as mounting government and government guaranteed debt, or that increasing level of indebtedness. Also on the minds of investors coming out of the mid-year review, as well as the fiscal 2020-2021 initial budget statement or full year budget statement, was inflation considerations or concerns. And of course, how all of these factors, among others, are going to affect company performance. Well, let's take a look at the foreign currency situation, and that net official reserves figure and import cover continues to fall. In fact, the net official reserves would have fallen from a peak of around $11 billion to its current figure in May 2021 of around $6.7 billion over the course of several years, of course. But nevertheless, that decline continues to be a trend, a somewhat worrying trend for net official reserves. And of course, investors are keenly monitoring this to consider the availability or access to foreign currency, which continues to remain constrained. Now, on the in terms of relatively good news, import cover has stabilized at around that 8-month level, which is quite healthy relative to international standards. But in absolute terms, of course, that net official reserve decline continues to be somewhat of a worry for investors and the general business community as a whole. Now, when we take a look at the Heritage and Stabilization Fund, that is some relatively good news as well in terms of the overall level and the net return and contributions. We can see that Heritage and Stabilization Fund overall has remained at around that $5.7 billion to $6 billion range over the past few years, helped quite significantly by very robust financial market performance and the performance of its investment portfolio, despite multiple withdrawals from the HSF. As at May or the end of May, it would have been around that $5.65 to $5.7 billion figure overall, which is a good indicator in terms of foreign exchange stability, at least in the short to medium term, given that this can be a readily accessible source for drawdowns in the case of need by the state, if that is in fact warranted. However, that really has not helped the foreign exchange availability or market in general to investors who continue to have concerns about that level of availability in general for investing and other purposes. Now, one of the other factors that investors have been looking at has been that increasing level of the net public sector debt to GDP ratio. And at the mid-year review, it was estimated that debt to GDP ratio has climbed to in excess of around 85% at the half-year level, and continued borrowings are anticipated given the significant revenue shortfalls that are taking place. Notwithstanding an improvement in energy prices, production has remained somewhat constrained, and that has continued to lead to lower than expected revenues for the country. Now, when we take a look at inflation, which is also another concern that many investors have on their minds right now, we see that the statistics show that inflation remains relatively subdued. Headline inflation in that bright yellow line is around 0.8% currently and has trended along that level over the past several months. Core inflation in that red line has been, is currently around 0.5% and has remained at relatively low levels. Food inflation has ticked up or spiked in recent times, climbing to just over that 4% level, coming back down to that around that 2% level. But with commodities prices increasing and supply chain issues pervading global markets, we can expect that inflation could rear its head in the very near future. Now, fuel prices, water rates, and power rates are all up for liberalization or review based on the Minister of Finance's initial assertions way back in the fiscal 2021 budget reading. Devaluation, not so much. In the mid-year review, the Honorable Minister of Finance did assert that there was no plans to adjust any FX rate at this point in time. So with all of those factors in mind, is there going to be fast recovery in terms of growth? Well, that likelihood appears relatively low right now, given that the economy is still under significant restrictions. So investor confidence will be dented. Inflationary pressures could be rearing their head sooner rather than later, and that is a higher likelihood, given, well, especially if water, power rates, and fuel prices are liberalized, which leads to generally lower investor confidence. Continued government borrowing is expected, and that could have some investor concerns in terms of a lower credit rating for the country and higher borrowing costs. Yes, there are going to be continued HSF drawdowns, especially in the context of significant revenue shortfalls, which could lead to deterioration in national savings and a generally lower level of confidence. How will that affect corporate earnings? Will they be under pressure? Well, it all depends on which stocks you pick, which companies you focus on, and definitely you should be focusing on the winners, investors, that is. Look for businesses that are relatively pandemic proof, that have a significant degree of geographic diversification outside of Trinidad and Tobago, are in strong financial positions in terms of their financial health, pursuing growth opportunities either organically through introducing new products or through acquisitions, as has been the case of quite a number of companies in recent times, and of course would have good recovery prospects as the economy or regional economies continue to normalize. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website at boursinvestment.com. And of course, you can catch this article in the Bigger, Better Trinidad and Tobago Guardian business section today. Have yourselves a wonderful investing week. This has been the Bourse Report.